Okay, we're going to finish up with chapter 14.3, and this is it. We're done after that. A written and signed promise to pay a sum of money at a specified time is called a promissory note. And so a person to whom a liability is owed is a creditor. So if I took a mortgage, a loan to pay off a building from TCF Bank, the TCF Bank would be the creditor. I would sign a promissory note saying, I am promising to pay you back this much money with this much interest by this time. A promissory note signed by a business and given to a creditor, that is called a note payable. So I am paying it in monthly installments over 30 years, and I'm going to sign a notes payable. Now that if a business accepts from a customer a note receivable, that means the same thing. They bought something big from us. It's not just an accounts receivable. It's going to be a longer term loan. They are going to owe us, so it's a note receivable. Notes payable and notes receivable are frequently referred to simply just as notes. A person or business that makes the note and thus promises to make the payment. So if I buy a building and I need a mortgage to pay on it, I am the one who signed it and promises I'm the maker of the note. The person or business to whom the amount of the notes payable to, so TCF Bank would be the payee. The original amount of the note, which is also called the face amount, is the principal. So that's the starting balance of what I need to owe and pay on it. And then I also need to pay something called interest. So that's the percent of the principal that is due for the use of the funds secured by the note. That's interest rate. So interest rate is what makes it expensive to pay it back. The higher the interest rate, the more money you're paying back in interest. The date when it's due in the future, when you have to have it all repaid by, is the maturity date. And the length of time, so if it's 10 years, 20 years, 30 years, is the time of the note or the term of the note. So this is an example of a promissory note. It has to whom it's paid to whom it's due from, how long they have to pay. So generally 30 days or more, or 90 days or more, 3 months. And the amount of money they need to pay with the interest rate stated. So we have the number assigned, the date the note assigned, the time of the note, so how long in the future they have to get it paid by the payee to whom it's due to, the principal, that's the amount that they are borrowing, the interest rate, and the maturity date. This is the maker of the note, so the person who is going to owe the note. So the signee is the maker of the note who is going to owe it, and then witnesses. Okay, if you accepted a 90-day 8% note from Skinner College for an extension of time on its account, they need 90 days to pay $2,578.35. That reverts it to a notes receivable instead of an accounts receivable. So now we're going to have a debit into note receivable because now we'll take it out of accounts receivable and put it into our notes receivable. That's the principal amount. And then we have to put it into our accounts receivable ledger with Skinner College being the person who owes it to us. They are our customer. So we're going to put it in the general journal. And we're going to put the date. We'll put our debit, which is notes receivable. And then we're going to give it the distinction of NR, note receivable, and put the debit amount. And then we're going to credit out accounts receivable so it's like it's not there at all. And Skinner College. And that diagonal line, remember, is because we're going to post to both accounts receivable and Skinner College. And the credit amount, debits equal credits. And amount paid for the use of money on a period of time is called interest. Most of you have probably taken personal money management or know something about interest. And we know that principal times interest rate times time is the amount of the interest. So in this case, our principal was $2,578.35. Our interest rate is 8%, and we are paying 90 days, or they have 90 days over the 360 business days there in a year. There's 365 days a year, but businesses use 360 as the fraction, the number of days in a year. So we take 2,578.35 times 0.08 times 90 divided by 360, you get 51. Sorry, 51.57. So they're going to have to pay us back $2,578.35 plus 51.57. So the amount that is due on the maturity date is the maturity value. So in this case, both of those amounts equals the maturity value. They have to pay us our interest and our principal. So the maturity date of a promissory note, we know it's 90 days. So we need to know, given all the time frame out there, if they started on March 18th. March 18th to March 31st, there's 13 days to the end of the month. 13 days in that month of March. So they had 90 days to pay, minus the 13 in March. They have 77 days remaining. All of April's 31 days and all of May is 31 days. So 47 days left after the end of April and 16 days left at the end of May. So we know it'll take 16 days of June to get to that 90 days. So we're just doing the 13 days of March plus the 30 plus the 31, which 16 days would give us till the end of the maturity date. When a note receivable reaches its maturity date, the maker of the note is expected to pay the maturity value, so the interest plus the principal, and the interest earned on money loaned is the interest income. The interest earned on a note receivable is credited to a revenue account. We had sales as a revenue account, but now we have something called interest income. So we received cash now on June 16th when it was due. Received cash for the maturity value of note receivable number 6, a 90-day 8% note. They have to pay the principal plus the interest. We need to debit our cash. We're getting cash in of the total amount. But we are crediting notes receivable. They don't owe us that principal amount, but we also need to credit revenue. Remember, sales is always a credit. Well, any revenue is a credit. So interest income is going to go up with a credit for the interest amount. So we're going to put it in the cash receipts journal. We're getting money. So this is a case that we're going to have two general amounts in the column. So we're going to have two account titles written. And the date is June 16th. Notes receivable and interest income are going to be credited. The doc number is the receipt 782. So both of those credits should equal our cash debit. Remember, our cash is the main amount because it's a cash receipts journal. A note that is not paid when it's due is called a dishonored note. So it does not come through by the 16th. We need to record that. Stout Company dishonored note receivable number 4, a 60-day 8% note. Maturity value due today, principal $3,000 plus interest they were supposed to pay, which is $3,040 in memorandum 98. So we're going to debit accounts receivable, and we're going to credit notes receivable. They dishonored it, and our notes receivable is going to also go up the $40 because it owes us the $40 of interest. So we also need to record it in Stout Company that they owe us $3,040. So we're going to put it in the general journal, debiting accounts receivable Stout Company, the total amount of $3,040, the notes receivable of $3,000, and the interest income of $40. They did not pay us back, so we do not put it in our cash receipts. What conditions might cause a business to delay payment to a vendor? The receipt of cash from sales does not occur at the same time in an amount sufficient to pay for needed purchases and expenses. I'm sure a lot of times now during COVID, businesses don't have it, so they might need to extend their accounts receivable to notes receivables. What is the advantage of a promissory note over an accounts receivable? A note can be useful in a court of law if they have to take up to court to say, hey, you didn't pay. They have a paper trail that follows. What does an interest rate of 10% mean? That means 10 cents will be paid for the use of each dollar borrowed on a full year. So $10 would be paid back on $100. What is written in a customer's account when a note is accepted and a note is dishonored? The words accepted note and to dishonored note are written in the item column of the customer's account. Let's look at the working together. Okay, work together, page 430. We, for each of the following notes, calculate the maturity date on the note and the interest on the note and the maturity value. So we have an 8% interest rate and a 6% interest, 90 days and 120 days. So we have to look at, for some reason I can't see it all. Let's make sure. Okay, so we have term of the note, and it's starting 90 days, June 5th. So we have June, and we are looking at from the 5th, and we know that June has 30 days. So from the 5th, we have 25 days. I wanted to look at how they wanted to list it. So we want really June 5th, June 30th, 25 days. We're going to go equals 90 minus 25. So now we know we have 65 days left. And we have July now, all of July. We have 31 days. So we have equals 65 minus 31. And we have 34 days. So we know August has 31 days. So we can go 34 minus 31. And so we have September 1. So we have the first, second, third. So September 1st to September 3rd. 3 days equals 3 minus 3. So here we have interest. We should have, our interest is going to be $20,000 times 0.08 times 90 divided by 360, that magic number of days a year banking industry has. $400 is our interest. So what will our maturity value be? Our principal is 20,000 plus our interest. Okay, now let's scroll down here, 120 days. And we're starting June 2nd, 12th, sorry, June 12th through, we know there's 30 days. June, July, August, September. Now we're gonna, I know that the 12th through the 30th is 18 days. Sorry, my computer. So I take 120 minus 18. And my computer. And July is 31 days. So we have equals 102 minus 31. And we know we have 71 days minus August 31 days. I'm going to enter it in here. September. And September has 30 days. So equals 40 minus 30. So we know that October is going to be 1 through 10th, so 10 days. We have 0 left. We are going to do our interest, and we need to know it's $10,000 at 6%. $10,000 times 0.06 times 120 days. 120 days divided by that magic number 360 to get $200. I want to see all the words here. So we have $200 we need to pay in interest. Now we need to add the principal to the interest here. And we go equals 10,000 plus interest to get then 10,200. Okay, we can go up here now, enter all this in, $400 in interest, $200 in interest, maturity date of September 3rd and October 10th. And the maturity value of 20,400 and 10,200. Okay, that's all we have to do for that file or that sheet. Now we need to go into the general and cash receipts journal, and we need to journalize our 3 transactions. It says on page 7 and 8, page 7 and 8, which is listed for us. We are going to do our first transaction, accepted a 90-day 8% note from Gary Kinney. So the year and July 5th, and we are going to take our notes receivable, our debit. Our document is NR5, and our amount is 1,800. And our credit will be 1,800. And our credit will be accounts receivable, Gary. And we're going to indent it. Now, obviously, these are different amounts than what we worked with before. So we're going to treat it as separate. Now, on July 12th, we received cash from Mary James for the maturity value. So we have to go down here. We receive cash. So we have July 12th. And we have notes receivable. And our 113 is our receipt. And it's a credit because they're paying it off. Receive cash. And we're going to have to calculate because we need to know how much their interest income is. We're paying interest income as well. And so we have a $500 9% note for 60 days. So we're just going to do $500 times 0.09 times 60 days divided by, you always have to divide by, so it's the amount of time divided by 360. So you get $7.50. So our cash we're going to receive would be a total of this plus this. Okay. I'm going to make it look the same there. And our last is Dennis Kraft dishonored a 90-day 9% note for $400. So we're going to put that up here, July 26th. And we're going to put it back into accounts receivable for Dennis Kraft. He's going to have to owe us again M25 because we're putting it right back into accounts receivable. And it's a 90-day 9% note for $400. So we are going to credit notes receivable. We're also going to credit interest income because we need to still get money. He owed us for that time. We need to get money for our time of waiting. So our note was for $400. And our interest rate was $400 times 0.09 times 90 divided by 360. Now Excel does your math. PEM does for you. I should have brought that up. It will multiply and then divide. But if there's ever a question, remember, you can put parenthetical here. You can put in your parentheses. But in this case, you're fine because you don't have any addition or anything like that. So you don't need to put the parentheses for this. So our accounts receivable, we have to charge them that interest as well. So it's going back into accounts receivable, $400 plus the $9 he owes us. Okay, you guys would have to post it in the general ledger. Not going to make you do that. So you guys could just do the first two tabs for application 1413, and that's it. You're done.